Ever wondered what the different types of investments are and how they can benefit you? Welcome to the world of asset classes, the categories that investments fall into based on their characteristics and risk-return profiles. From equities and bonds to cash equivalents, real estate, commodities, alternative investments, and even derivatives, each asset class brings its own unique features to your investment portfolio. Over the next few minutes, we will dive deeper into each of these asset classes. Starting with equities, or as you may know them, stocks. These are essentially ownership shares in a company. When you buy a stock, you're buying a piece of that company, which gives you a claim on its assets and earnings. Stocks offer the potential for capital appreciation, which is when the price of the stock increases, and dividends, which is a portion of the company's profits paid out to shareholders. However, stocks can also be risky. The price can fluctuate, and there's always the potential for loss. Now let's move on to fixed income securities, often referred to as bonds. These are debt instruments issued by entities like governments or corporations. When you buy a bond, you're essentially lending money to the issuer in exchange for periodic interest payments and the return of the principal amount at maturity. Bonds are generally considered less risky than stocks. They offer a steady income stream, but with lower potential returns. While stocks offer potential for high returns, they carry a higher risk, whereas bonds, on the other hand, are generally less risky but offer lower potential returns. Now, let's turn our attention to cash equivalents and real estate. Cash equivalents are highly liquid and low-risk investments. These are assets that can be easily converted into cash, such as treasury bills, money market funds, or certificates of deposit. The key advantage of cash equivalents is their stability and safety of principal. However, this safety often comes at the cost of lower returns. On the other hand, real estate refers to physical properties. These can include residential, commercial, or industrial buildings as well as land. Investing in real estate can generate rental income and offer potential capital appreciation. However, it's important to remember that real estate investments also involve management responsibilities and liquidity considerations. Unlike cash equivalents, you can't instantly convert a building or a piece of land into cash. In essence, cash equivalents provide stability and safety of principal, but typically offer lower returns. And real estate, while providing rental income and potential capital appreciation, involves management responsibilities and liquidity considerations. Finally, let's explore commodities, alternative investments, and derivatives. Commodities are raw materials or primary agricultural products like gold, silver, or oil. These can be traded on exchanges, and they provide a hedge against inflation and currency fluctuations. Now, let's turn the spotlight to alternative investments. These are non-traditional assets that don't fit into the usual categories. They include hedge funds, private equity, and even cryptocurrencies. Each of these investments has unique risk-return characteristics and can offer opportunities for diversification. Lastly, we have derivatives. These are financial contracts whose value is derived from an underlying asset, index, or security. Derivatives such as options, futures, and swaps can be used for hedging, speculation, or leveraging investment positions. However, they carry higher levels of risk and complexity. These asset classes offer unique benefits, from hedging against inflation and currency fluctuations with commodities, diversification with alternative investments, to leveraging investment positions with derivatives. So, why should you care about understanding these different asset classes? Well, each of these asset classes, equities, fixed income securities, cash equivalents, real estate, commodities, alternative investments, and derivatives, carry their unique risk-return profiles. Diversifying your investment portfolio across these classes can help balance your risk and increase the potential for returns. By understanding these asset classes, you can tailor your investment portfolio to your individual risk tolerance and financial goals, helping you make more informed investment decisions.